Gold just did something it was never supposed to do. The same central banks that spent decades suppressing its price are now panic buying it at record levels. And by the end of this video, you'll understand why the secret gold cartel is losing control and what this shift could mean for your money. In the shadows of global finance, a silent war has been raging for decades, one where the world's most powerful institutions have held the reins on humanity's oldest store of value, manipulating its price to serve their agendas. But now, as the dawn of a new era breaks, those reins are slipping away, and the yellow metal is roaring back with a vengeance that could reshape economies and fortunes alike. Imagine waking up to find that the gold your grandparents buried in times of crisis is suddenly worth more than ever before, not because of some fleeting market whim, but because the very guardians who once suppressed it are now scrambling to hoard it themselves, their iron grip fracturing under the weight of geopolitical storms and unrelenting demand. This is not just a story of rising prices, it's the unraveling of a secret cartel, a coalition of central banks that have long dictated the fate of gold, only to find themselves outmaneuvered by forces they can no longer control. And as we delve into this gripping tale, you'll see how this loss of dominance signals a profound shift in the balance of global power, one that could make early believers wealthy beyond imagination while leaving the skeptics in the dust of regret. Picture the scene. It's the early hours of a crisp October morning in 2025, and traders across London, New York, and Shanghai stare at their screens in disbelief as gold shatters the $4,000 barrier for the first time in history, not with a whimper, but with a thunderous surge that echoes through the financial corridors like a declaration of independence from the old order. This wasn't supposed to happen, at least not according to the playbook written by the central banks, those monolithic entities that have treated gold as a relic to be managed, suppressed, and occasionally unleashed to stabilize their fiat empires. For years, they've operated like a shadowy cartel, leasing out vast reserves to flood the market when prices dared to climb too high, using futures contracts to paint the tape and scare off speculators, all while maintaining an illusion of abundance in a world where true scarcity was always lurking beneath the surface. But something has changed fundamentally in 2025. The central banks aren't just failing to hold the line, they're joining the frenzy, buying gold at record paces, driven by fears of dollar debasement, escalating trade wars, and a geopolitical landscape that's more fractured than at any point since the Cold War. This pivot isn't born of ideology, but of necessity, as emerging market powerhouses like China, India, Brazil, and Poland lead a charge to diversify away from U.S. treasuries, stockpiling the yellow metal as a hedge against the very uncertainties their Western counterparts once exploited to keep prices low. As we peel back the layers of this intricate web, we'll uncover how this cartel formed, why it's crumbling now, and what it means for the average investor watching from the sidelines, caught between the allure of potential riches and the peril of missing the boat. To grasp the magnitude of this upheaval, we must journey back to the roots of the so-called gold cartel, a term whispered in trading pits and conspiracy forums alike, but one grounded in verifiable history that reveals how central banks have wielded gold as both weapon and shield. It began in earnest after the Bretton Woods system collapsed in the 1970s, when the US dollar severed its final ties to gold, ushering in an era of floating currencies, where central bankers feared the yellow metal's allure as a safe haven could undermine their monetary policies through mechanisms like the London gold pool in the 1960s, and later through sophisticated derivatives markets. Institutions such as the Federal Reserve, the Bank of England, and others coordinated efforts to cap gold's price, often by leasing physical bars to bullion banks who would sell them into the market, creating artificial supply to counteract natural demand. This suppression wasn't mere theory. Declassified documents and whistleblower accounts paint a picture of deliberate interventions, where spikes in gold were met with coordinated sales or margin hikes on futures, exchanges designed to trigger stop losses and cascade selling among leveraged traders. For decades, this worked flawlessly, keeping gold in a range that discouraged widespread investment, while allowing central banks to bolster their reserves quietly during downturns. Yet, as we fast forward to 2025, the cracks in this facade are widening into chasms, exacerbated by a perfect storm of events. The ongoing Russia-Ukraine conflict has accelerated de-dollarization efforts, with sanctioned nations turning to gold as a neutral asset for trade settlements. U.S.-China trade tensions, including fresh tariffs and tech embargoes, have inflamed inflationary pressures worldwide. And a series of Federal Reserve rate cuts, starting with 3 in 2025 alone, have weakened the dollar, making gold's shine even brighter in comparison. Central banks, once the sellers of last resort, have flipped the script, purchasing over 634 tons in the first half of the year alone, a record that shatters previous highs and signals a desperate bid to shore up reserves, amid fears of a multipolar world, where the greenbacks, dominance is no longer assured. As the sun rises over the financial districts, the evidence of this cartel losing its grip becomes starkly apparent in the price action itself. A volatile dance that tells a story of attempted manipulations foiled by overwhelming demand. Just weeks ago, in late November 2025, we witnessed a classic suppression tactic unfold. As gold approached 4,200, whispers of coordinated futures selling from major bullion banks flooded the order books, painting the tape red and triggering a sharp 5% dip that sent retail investors scrambling for the exits. This was no accident. It mirrored the playbook from 2011 or even the infamous 1980 Hunt Brothers squeeze, where margin requirements were hiked to force liquidations and restore order. But unlike those past episodes, the dip didn't hold. In fact, it barely lasted 48 hours before a massive rebound erased the losses and propelled gold to new heights, gapping up overnight in Asian trading sessions where sovereign funds and industrial buyers absorbed every ounce on offer. This V-shaped recovery wasn't just resilience. It was a rebellion, the market's way of screaming that the old tricks no longer work, because the composition of buyers has evolved beyond the cartel's calculations. No longer dominated by speculative hedge funds with shallow pockets, the gold market now teems with strong hands. Central banks from emerging economies, wiring billions to secure physical bars, family offices, diversifying generational wealth away from volatile equities, and even tech giants hedging against supply chain disruptions in electronics and renewable energy. The failure of this recent smash attempt sent shockwaves through the system, with lease rates spiking as banks realized their leased gold might never return, consumed in solar panels or EV batteries, forcing them to buy back at premiums that only fuel the upward spiral. Psychologically, this shift breeds a toxic mix of regret and fear of missing out, where those who sold during the dip wake to find their positions liquidated at the bottom, now chasing re-entry at premiums that sting like salt in a wound, amplifying the rally as panic buying cascades through the ecosystem. Delving deeper into the mechanics of this unraveling, we uncover the pivotal role of the float, the available, unallocated gold that once provided the cartel with its ammunition, and how its depletion has turned the tables irrevocably. For years, the London Bullion Market Association served as the cartel's arsenal, with vaults holding billions in ounces that could be mobilized to dampen rallies. But inventory isn't the same as float. The latter is the liquid metal ready for immediate sale or lease. And in 2025, that pool has evaporated under relentless demand. Reports from the World Gold Council highlight how central bank purchases alone have drained hundreds of millions of ounces, with nations like Poland adding 96 tons, Brazil surging ahead, and China quietly amassing reserves that now rival major Western holdings. This isn't hoarding for hoarding's sake. It's a strategic pivot away from US dollar-denominated assets, driven by sanctions, trade wars, and the specter of inflation that no amount of Fed tinkering can fully contain. When Samsung or Tesla needs gold for their next-generation batteries, they can't tap into ETF-held bars locked away by long-term investors. They hit the float, and finding it empty, they bid up prices to lure diamond-handed holders into selling. The cartel's response? A frantic pivot from suppression to accumulation, with even traditional suppressors like the Bank of England facing pressure as their own government's eye. Gold is a bulwark against fiscal deficits, ballooning from pandemic recoveries and green energy transitions. This liquidity crisis manifests in soaring premiums for physical delivery, where COMEX futures diverge from spot prices, signaling that paper gold, the cartel's favorite tool for manipulation, is losing its tether to reality, as allocators demand serial-numbered bars moved to private vaults, triggering what amounts to a silent bank run on the system. Amid this turmoil, the emotional undercurrents swirling through. The market add layers of drama that no chart can fully capture, transforming what could be dry analysis into a human saga of greed, fear, and ultimate vindication. Think of the veteran investor who bought gold at $2,000 an ounce back in 2020, enduring years of sideways grind and mockery from stock market enthusiasts, only to watch it double and then some in 2025. Their patience rewarded as the cartel's facade crumbles. Contrast that with the hedge fund manager who shorted gold at $3,500, confident in the old suppression mechanisms, now facing margin calls that could bankrupt their firm as prices vault toward $4,500. Regret fuels this fire. The V-shaped recoveries we've seen this year act as regret machines, forcing sellers to buy back higher, their FOMO turning into a self-fulfilling prophecy that propels the metal further. Geopolitically, the stakes heighten the tension. With U.S. elections looming in 2026 and tariffs reshaping global trade, gold becomes not just an asset, but a symbol of sovereignty. As countries like Russia and Iran use it to bypass SWIFT and dollar hegemony, eroding the cartel's foundational power, this emotional highs reach a crescendo in moments like the October breakthrough. where traders describe a euphoric rush as resistance levels shatter. But suspense lingers. Will the Fed intervene with a surprise rate hike to bolster the dollar, or has the multipolar world rendered such moves futile? The psychology here is market sadism at its finest, inflicting maximum pain on the establishment, banks with short positions hemorrhaging billions, industries scrambling for supply, and policymakers watching their tools blunt against a tide they once commanded. As we approach the climax of this narrative, the technical roadmap ahead crystallizes into a battleground where $4,500 emerges as the next line in the sand, a psychological and derivatives-laden barrier that could unleash a gamma squeeze of epic proportions if breached. Currently trading around 4,350, gold has reclaimed its November losses with authority. But $4,500 isn't mere resistance, it's liability incarnate. With massive call option open interest clustered there for January contracts, bets placed by institutions wagering on continued upside. If prices creep closer, market makers, often the bullion banks tied to the cartel, must hedge by buying futures, their algorithms kicking in to amplify the move, creating a feedback loop reminiscent of the GameStop saga, but on a global scale. The cartel will fight tooth and nail here, deploying paper shorts and volatility spikes to defend. But the odds favor the bulls. Asian demand remains insatiable, with India and China absorbing record imports amid festival seasons and economic stimulus. Western ETFs, dormant for years, are seeing inflows as retail investors chase momentum. And mining stocks, lagging the metals rise, present arbitrage opportunities that savvy players will exploit, pulling equities higher in a catch-up trade. When U.S. markets open each day, the tension peaks. Will the dollar index rally to cool commodities, or will FOMO overwhelm, with volumes surging as Americans join the stampede? Given the structural forces at play, persistent inflation hovering near 3%, Fed cuts signaling accommodation, and geopolitical flashpoints like the Middle East tensions, the path of least resistance points upward toward $4,800 by year-end if the dam breaks, a climax that would confirm the cartel's defeat and ignite the next leg of this historic bull run. Yet, even as we revel in this turning point, a satisfying resolution demands we zoom out to the macro vista, where the secret gold, cartel's loss of control heralds not just higher prices, but a profound wealth. Transfer from the fiat guardians to those who bet on tangible reality. For 40 years, wealth flowed from the physical to the digital, from mines to memes, from gold to growth stocks. But 2025 marks the reversal. With gold up 30% year to date and poised for more, it's proof that you can't print prosperity forever, that labor, energy, and geology underpin true value in a world awash in digital debt. Central banks, once suppressors, now accumulators, have locked the door on low prices forever, their reserves swelling to levels where gold surpasses. U.S. Treasuries, for the first time in generations, a silent admission that the dollar's era of unchallenged supremacy is waning. As we head into 2026, seasonal tailwinds like year-end window dressing will add fuel, with funds rushing to own the asset of the year to salvage their reports. Their price-insensitive buying pushing us parabolic. For investors, the strategy is timeless. Accumulate physical gold or unhedged miners, ignore the noise of daily swings, and let the structural shortage do the work. Samsung's batteries, China's hoards, the empty vaults, all conspiring to elevate the yellow metal. Your grandchildren will ask what you did during the great resource pivot of the 2020s. If you held firm, you'll tell tales of vindication, of watching a cartel crumble while fortunes were forged. The war isn't over. Volatility will intensify, swings widening from dollars to tens. But the momentum is with reality now. And in this rally, the diamond hands prevail, enjoying the fruits of a metal that's not just rising, but reclaiming its throne. Thank you for staying with me till the end. Here on The Scope, we dig past the headlines and uncover the hidden layers history tried to bury. If this documentary made you think differently, hit subscribe. Your support tells me to keep creating deeper investigations. Share this video with someone who loves powerful, untold stories, and leave your thoughts in the comments. I read everyone. A new, even stronger documentary is already on the way. So stay curious, and I'll see you again soon, right here on The Scope.